Yes, perfect. So in the previous video, we touched on targets. Now we are going over the last foundational level, which is risk management. Now, of course, those foundational levels all need time as well. So in the next two videos, we are going to go over time, cover everything you need to know about time, and then afterwards, you are already set out to have your foundational levels ready, your bias, narrative, boundary, target, entry pattern, and your risk management. Of course, these are only the first 2 weeks, so we're going to build onto that as well. Now, it's very important to know as a trader what allows us to actually be a trader. What allows us to be a trader is risk management, is the RR, is the overall win rate that we have, etc. So risk management is at the core. It's basically everything that allows us to be a trader in the first place. If we didn't have risk management, then we would basically be gambling. So if we don't stick to risk management and we don't respect risk management, then we are basically gamblers with a gambling addiction, you could call it. And what I'm referring to there is people trying to trade NFP, people trying to trade CPI, FOMC on the news release itself. I do not mean after the news release, etc. I mean on the actual news release itself. Let me explain why. Here on Euro US dollar and on every other pair, of course, we had NFP right there on that Friday. Now, if you try to actually execute on this candle itself right there, that is not trading. That is simply gambling. Why is that? Well, if this trade was to go against you right there, then yes, you see this candle on TradingView. The broker is allowed to slip you. In other words, the broker doesn't have the obligation to fill you at the right spot, because at that moment in time, it's also higher risk for them to fill people, etc. So right there, they don't have that obligation to fill anyone at that moment in time. Where spreads open, slippage starts to occur. When slippage starts to occur, and let's say we took a long trade right there, and we had our stop loss right there, in your demo account, in our demo account, we would get filled out, and our stop loss would be perfectly hit right there. In a real account, your stop loss right there would not get respected. And if you're lucky, you might have gotten filled right there. If you're extremely unlucky, you might have gotten filled out right there. Which then leads you to, instead of losing 1% of your account, leads to then losing maybe 2%, 3%, 4%, 5% maybe. So what are we doing right there if we are taking an NFP trade? That is when we are gambling. Why is that? Because if we are gambling right there, we are risking 5% to maybe make what? 2%? We're doing a negative RR. So if we want to be traders, we need to understand this, that this is the basis of trading, risk management. And the reason why this story is so important is because trading NFP, CPI, and FOMC on the release candle itself. So I actually mean 830 right there is NFP release. If you actually trade that exact candle, as in you execute on that exact candle, maybe 2 minutes before, something like this would also be considered as, I would definitely not look to do that right there. Just wait after that candle, and then afterwards you can get involved normally again. That's very important to understand. And of course, that's what we're going to dive deeper into as well with time. But that is at the core of risk management as well. Understanding that risk management allows us to be in the game. So risk management should always be respected. It's someone that is allowing you in their home and you do not respect their home. You go against all their rules. Maybe you bring dirt in their home, jump on the bed, jump on the couch. It's like, what are you doing? You're in someone else's home. They allow you to be there and you're not respecting them. So that is, if you want to respect trading as a profession, then you should respect risk management. You should not trade those conditions right there on the exact candle release, on the exact news release. That is very important to understand overall. And that also leads to risk management allows us to be trader, because risk management is where we get to the RR, to the win rate, etc. If we want to trade news and we want to trade the exact candle again, on what I meant right there, then right there, if we can catch those moves, yes, you might catch those moves. And news very often is what I'll touch on in the next video as well. News is quite predictable. The only thing is that you need to be 100% right. As in, you need to have 100% win rate if you want to trade news, which is never going to happen. So if you have a little bit lower of that, then yes, you can make 5% on one day, 5% on FOMC, 5% on CPI, and the next time you do, you blow your account. That is not trading. That is purely gambling. Might as well go to the casino. So that is very important to understand. And that is just sort of a disclaimer that I also want to put out there, because I do not like seeing NFP, CPI, FOMC setups shared after the fact. Yes, on the actual candle itself, where the news release happens, no, please don't do that. That is not trading. That is just also sort of, again, like I mentioned, that's a sort of a disrespect to the profession trading. This is the same as the story with the Lamborghinis and all that stuff. It's also disrespect to the profession, which is called trading. And that is just something we need to know. So, right here, let's go over the other part, the more fun part of risk management, which consists of risk percentage, partials, and when to go break even. That is the main things you need to know right now about risk management. For your risk percentage, this depends on the certain conditions that we have. You always want to ideally risk around 1%. Now, it really depends on the conditions. So risk percentage is also something we are going to go into in the last week, the MMP week, where we have specific conditions on that. The main thing that we need to know is when we go into drawdown, then we need to understand that we lower risk. So ideally, again, 4% drawdown is where you, again, lower that risk to maybe 0.25%. Above 4% drawdown, so from that break-even line to that 4% drawdown, you ideally want to risk 0.5%. Everything above the opening balance, you could call it, I would argue, all right, let's risk 1% or 0.5%. After that, once we get confident, etc., we can go to 2% as well. But those specifics, again, is what we get into in the MMP week. Now, the next thing is partials. I want to go over this scenario again right there. I think we all understand the narrative, the bias overall. I also want to go over an example of the futures, which right here on the daily, we have this daily context, of course, targeting that daily premium rate in the form of that swing high. And we also had on the weekly, this swing high sitting right there. So that, again, we understood as the drawn liquidity. That is the drawn liquidity. That is the target, overall target. This is the context high. So that's the first target we actually encounter. Now, we have 3 rules to go break even. There is the first rule is within context, go break even when there's no reason to return. So what does that mean? Within context right here. And again, what is that context? That context is from that discount array towards that premium array right there. Then the next part is, all right, within that context, if there's no reason for price to return to our entry level, then is when we go break even. So that could be a little bit more subjective overall. I'm going to, of course, explain exactly how I would go about it. But we also have 2 more mechanical rules. The 2 more mechanical rules are, second one is once context is taken, make sure to be break even. So once the context is taken, which happens right there, that is when you definitely want to be break even overall. That's the same for this right there, which is the third rule. Once the draw on liquidity is hit, also make sure to be break even. So if your entry was quite high right there, once the context is taken and you weren't able to go break even just yet under certain conditions, all right, maybe because you're a swing trader, something like that, and you took a 4-hour entry here, something like that, then you definitely want to be break even once the draw on liquidity has also been hit. So both these conditions in the context right there and the draw on liquidity being hit, both are where you want to be break even overall. So that is quite important. Then let's look at the more difficult rule, which is the first rule. Within context, go break even when there's no reason to return. All right, we understand daily fair value gap, 15-minute ST plus RE. So let's see, when would we go break even right here? Well, we have the ST, and that's the fair value gap lower right there. And then afterwards, we have the fair value gap higher sitting there as well. Perfect. Then we have this new order flow leg, which is the RE right there. Also perfect. Then our entry was right there on the float, and we covered the lot right there because there was no reason to return towards that low. So when is there no reason to return here to our entry overall? This also depends on where your take profit is. Because let's say our take profit is a 1 to 2 right there. Then that would be a total different approach than if our take profit was on the context high sitting right there. That would be completely different and a sort of more a different approach as well. I'm going to explain why. That is because if we were to target a 1 to 2, we always need to take into account how far are we compared to our entry and compared to our take profit level right now. So if we target the high to the left right there, around a 1 to 2, perfect. So right there, currently, is there a reason to go break even? Well, we have this fair value gap, the first fair value gap that we are actually entering off of. Ideally, you always want to let the fair value gaps guide you to understanding when there's no reason to come back to your entry level again. What does that mean? Well, that's quite simple. As in, if we have the entry level sitting right there, once we create order flow legs above that entry level right there, and we create order flow legs higher with fair value gaps, of course, in them as well, then right there, that would be no reason anymore to return towards the entry level. Unless, of course, we have something on the time frame above us and there's a fair value gap below it. But if there's order flow legs above your entry level right there, that is when you want to go break even. Ideally, of course, order flow legs on the time frame that you are entering on, and as well, make sure they are in context. So if there's still an order flow leg, yes, but there's a 1 hour value gap right there below it as well, then of course that is not in context. So that is something we need to take into account. Now, right here, we had this fair value gap. We currently don't really have a reason to go break even, right? There's not even new discount array being created overall. Perfect, so we wait. All right, now we are creating an expansion phase here of a new fair value gap higher. Now, there's two things going through my mind here. There's the first thing that I just mentioned, as in, yes, Ario just mentioned right here, we still have a reason to come back potentially because there's an order flow lag still in that whole drawdown period that we had right there. As in that drawdown period right there that we had, there is still a reason to come back towards that because we don't have an order flow lag created above it, like I mentioned. All right, yes, that is true, but this is also where I'm going to try to make it as logical as I can and as objective as I can. It's going to be a bit subjective. I'm sorry for that, but you are going to understand it. I truly believe that. And with time as well, definitely this is something you are going to fully understand. Right here, if we look at candle signs and we incorporate what we talked about in the analyst phase, and now we incorporate it into our execution phase for risk management. Then right here, if we were to create a fair value gap higher, this new candle that we created right there would be what? It would be the expansion phase of a new fair value gap higher. All right, why is that important? That is important because right there, that means we should now, if we want to continue higher, create this fair value gap higher right there to continue that bullish intention overall. So if we want to continue that bullish intention, we are creating somewhat at that moment in time. Of course, we don't know exactly where the fair value gap will be, but we're expecting somewhat of a fair value gap being created right there. Meaning that again will be the next flood. That fair value gap will be the flood, the first line of defense. Then the second thing is that we have an overlapping defense right there as well. So we have first line of defense and the overlapping defense. Is it very likely right now, and we just measure this with the measuring tool that we have on the left side of my screen right there on TradingView. Let's measure this. This is something you can eyeball it. I like to eyeball it, but you can also measure it, where I simply measure at this moment in time, we are closer to the draw on liquidity, to our take profit right there. So our short-term draw on liquidity to our take profit, than we are towards our entry. Does it now make sense? If price is truly bullish, it wants to create that fair value gap. Does it now make sense for price to create that fair value gap, then disrespect that fair value gap, disrespect the order block that is sitting right there, come back to our entry right there, and then continue higher before it hits our take profit? Doesn't make any sense in my eyes, and that would indicate to me that we might even have unusual context to continue lower, because that indicates to me again that we don't really have that bullish intention. So right there, this is where we can already go break even. So this is definitely right there, and at that moment in time I actually was in this trade as well. This is where I was break even right there with that same exact logic. Then we hit take profit overall. All right, well, let's say our entry was a little bit higher, because this is also where risk management is important. We talked about entry types, and in the entry types, we talked about the first line of defense and the overlapping defense, right? Choose which one you want to enter on. Each has its pros and cons. The pros that the overlapping defense has, that the float sometimes just simply misses, is the risk management. The odds, the overlapping defense, if we were to enter right there, then you can go break even so extremely early that I would argue you could even go break even already once this candle, and I'm going to point towards the right candle, once this candle right there has closed. And that is extremely aggressive risk management that could be used in a moment where you are not sure. All right, am I really sure that price wants to continue higher? Maybe, again, that's where, of course, there's a thin line between am I really not sure or am I just not confident in my abilities right now? That also comes with time, with noticing, all right, I'm getting a lot of break evens right now. Maybe I should gain that confidence a little bit more to then wait a little bit longer. This is all part of the process. Believe me, been there, done that. That's all part of the process. So just go with it. Go with the process. It's a very fun process, believe me. So right here, if you have this accurate entry right there, I would argue that right there, you can definitely already potentially go break even after just this candle. Why is that? Because again, based on candle science, that means that we are respecting that order block right there. So based on candle science, the next candle should do what? Should expand higher. So can you see how we are now incorporating order flow and candle science for our risk management? And that's quite funny, right? Because we worked our way down. When we started the execution week, we started with market structure. Market structure, as we noticed it, it was quite zoomed out overall, and it was just a little bit easier to navigate the time frames and the lower time frames. It was quite easy. Then we zoomed in a little bit more, and we zoomed into order flow, where we looked at what are the fair value gaps telling us. Then we zoomed in a little bit more for our risk management now, to look at candle science to see when can we go break even, what can we expect. So here, I would again argue, you can go break even quite early right there. Especially if you are uncertain of what the setup actually wants to do. If you think, these probabilities are not the highest probabilities, so I am not too certain on if the draw on liquidity will actually be reached. All right, let me just activate my aggressive risk management mode right here, which is sometimes I like to do that if I like the setup, otherwise I wouldn't take it. But the high probability is just moi. It's not super there, as in it's not clearly visible. So, all right, let me make up for that with strict risk management, because strict risk management here allows you as well to demand high probability price action. And if it doesn't deliver towards your strict risk management rules, then you can already tell, no, that's not you hoping, etc. That's you being very strict with price. Hey, if you want to deliver towards that take profit, you better show me high probability price action. If you do not show me that, I'm out. Perfect. You set the boundaries right there for price action to do exactly what you want it to do. Absolutely perfect, because when you do that, then you know if price doesn't do exactly what you want it to do, it is low probability condition. So you wouldn't even want to get involved in it. So here, again, moral of the story is the different type of risk management, but also the flood and the odd right there, the different types of risk management that has its pros and cons. Where the flood, we would definitely get involved, but with the odd, our risk management is way, way better, because we can go break even a little bit earlier than we can with the flood overall. So here, again, it is important to understand, what do you prefer? Do you not like risk management and you notice I'm not the best at risk management? Perfect. Always enter on the overlapping defense and allow yourself to sort of ease off that risk management. If you always want to get involved, and of course we all always want to get involved, but if you notice that your risk management is great and you can definitely look at the chart with a clear mind, going over risk management, perfect. Enter on the flood. So right here, this is the difference between the flood and the odd. Now, we mentioned as well, what if we were to enter a little bit higher? And let's say we waited for this fair value gap right there to enter off of that, and we enter off the creation of a fair value gap. Now, as you know as well, if you enter off the creation of a fair value gap, which I also like to do sometimes, that does mean I am at high risk of a very bad and very painful risk management. So that is definitely something we need to take into account. Let's say I took this entry right here, covering the lot. There's nothing below that. There's no fair value gaps below this low sitting right there to head towards. So I know that low is most likely protected at the time, but I need to understand here, what is the 1 hour as well doing? Because the more time passes, of course, the more fair value gaps we are creating on different time frames. So the easier entries are always early on right there. But the better entries you could argue are later on, but they're also usually the most difficult entries. And not necessarily the most difficult ones, as in they're quite simple, but there's an overlooked point. And the overlooked point is just simply understanding, what is the 1 hour doing right there? Because the 1 hour is also creating a fair value gap right there. So that means, even though if the 15-minute right there was to create a new fair value gap higher, I would not go break even, because I know there's just simply a 1 hour fair value gap sitting right there, hovering in my drawdown area, where I will experience drawdown area. When I refer to a drawdown area, I mean the area between the entry and the stop loss. That is my drawdown area right there, where I will experience drawdown, where I'm in a loss overall. So here, let's say we were to target higher and we were to target, again, a 1 to 2 in a context. Right there. Perfect. Then at this moment in time, I am in the trade. So I'm definitely in the trade with entering off the fair value gap. But I also, I'm cutting myself in the fingers. That's a Dutch saying right there. I'm cutting myself in the fingers. What do I mean by that? I'm sabotaging myself. Why am I doing that? Because I want to get involved. I'm okay with the risk management, but this is definitely where the risk management now will be harder overall, because here it requires a lot of patience. So if you're constantly looking at the chart, if you have a quote unquote bad entry, so a late entry, or you're just experiencing a lot of drawdown and your stop loss is a little bit bigger overall, that means that you will have a harder time with your risk management. If you do not want that, then again, I would always advise to go for those more accurate entries. Demand a little bit more of a price. Demand that overlapping defense to be hit for you to enter. So right here, again, if you want to enter this, that's perfectly fine. I also enter like this when the time is there and when I do feel like the fair value gap might not see a sting into it. When that does happen, I know I need to be very aware with my risk management. I need to be patient. And I'm trying to sketch a live scenario because this is all fun and games in hindsight right here. And in a live scenario, it's a whole different story. And of course, that's what we're trying to transition to slowly. So I'm trying to prepare you for that because your mindset, and I'm speaking from my experience. So when I say your mindset, I'm just purely saying my mindset. You can replace the word your by my mindset, because that is my experience, how I experience that situation, which is likely very similar because we're all humans. So right here, how I would experience this situation is, all right, I have quite some drawdown. This is not really I like what I would like to have, but I gotta have patience here. So I need to wait for price to show me if I can go break even, which is the first rule. Within context, go break even when there's no reason to return. Is there a reason to return? We have the 1 hour value gap below our entry, so yes, there's a reason to return. After this, move higher. Is there a reason to return right now? Yes, there's still reason to return at this moment in time right there. We could argue overall that we had also the expansion phase right there. The only difference between this entry and that entry that we had earlier, and why I would go break even on this entry and not the second one, whilst we are also potentially creating both expansion phases, is because this entry, the second entry, was not accurate. It wasn't accurate at all. So we have a lot of more drawdown. We don't just have a sting into our drawdown area. No, there are fully candle closes in our drawdown area overall. So here, this is where I would still wait a little bit overall. Then after that, we just mess around right there. We almost hit stop loss right there as well. This is stress, stress, stress. Now, how can we avoid this stress? Also something we are going to go over, because here at this moment, you would not want to stare at your chart all the time to go over your risk management. It takes 45 minutes, potentially. So that's in the best case scenario. It takes 45 minutes to create a 15-minute fair value gap. If you were to look constantly at the chart the whole day, it takes so much time off your hands. It takes so much energy away from you. When I stare at a chart, and yes, I'm a trader, but when I stare at a chart, funny enough, I get drained. My energy gets drained. I'm useless at the end of the day if I stare at a chart the whole day, because I feel I get all these thoughts. I don't feel good anymore. It drains your energy. So this is not something you would want to do. You want to walk away from the chart, set alerts, which is again something we are going to go over later on in a different video as well, which adds on to risk management. It's a psychology part. So right here, this is stress, and we still have no reason to go break even. So at this moment in time, we probably accepted a loss, right? We're probably sitting right there. Well, yeah, this is going to hit our stop loss. Never mind, I'll just walk away or do something else. All right, boom. All right, quite nice. Now, at this moment in time, would you go break even? Well, our take profit is hit. Perfect. But I mean, at this moment in time, when we are creating that candle. So if we go into the 5 minute, hopefully we get a candle before that. Oof, right there. Yes. So at this moment in time, whilst that 15-minute candle hasn't hit our take profit just yet, would you go break even? Yes. Because right now we are just simply exploding again. We have that huge fair value gap higher potentially. This is where you now would go break even. Because again, now it's measuring. All right. We are closer to the draw liquidity, to our take profit. Then we are coming back to our entry level to then go higher. Now, this is also a good measure on if you are sometimes hoping for something to happen instead of just being objective. And that is when you are expecting a retracement right there, or you think that that retracement is reasonable right there before we hit the take profit. It's absolutely unreasonable, and that is usually comes from a sort of hope. But what if it does that? What if it still hits my take profit? I don't want to miss out on the winner. That is all things, again, what we're going to touch on in psychology as well. So this is the basis of risk management. Now, there, eventually, let's say if we were in the 1 hour trade right there, and let's say in the 1 hour trade, we wanted to target higher. And the first target is a 1 to 2. So let's say we wanted now to take partials. How would we go about that? My partial advice would always be the same. And my partial advice is very simply said, it's you partial at a 1 to 2 RR for 80%. After that, you leave the 20% of the original position running towards whatever you want to target after that. Now, do I personally partial? No. simply because I do not deem it as worth it. I do not see it as worth it as well. And I've gathered data on it for my personal plan. Your plan might be a little bit different on the way you approach it, but overall, for me, it is not worth it. If I hold the trade a little bit longer, then instead of having that stress of the 20% that's left on the table, etc., I just like to close the trade fully. I think that's more worth it. And from my data, that also shows it is more worth it overall. So if you do want to partial, which I can understand, let's say you were to target this high right there, you have 2RR, 80% of the table, perfect, 80% partial, and now you want to target not only this high, but also that draw on liquidity sitting right there. Then what do we need to do? We take 80% off at 2RR, perfect, we let the rest run. We need to make sure once this draw on liquidity, that context high, the first target, has been hit, what is the rule? Once context is taken, make sure to be break even. So you want to be break even right now because you don't know what is going to happen after. Do we want to create new context? That can happen, but that is lower probability than just sweeping the high and potentially messing around like we're seeing right there, to then sweeping the overlow to then continue higher. So you want to be break even once the context high right there has been taken. And again, the partial rule is quite simple, where you would now take into account the overall 2RR, 80% of the table, leave 20% running to whichever target we had. And the partial target, overall target, would then be ideally the context. If your 1 to 2 was above that context, so if the entry was something like this, for example, and the 1 to 2 was above that, you ideally, of course, again, want to be break even once context is taken. And after that, if we hit the 1 to 2 overall, then the next target could be the draw on liquidity for your overall partial. So that is how I would go about it. Play with those targets that we discussed in the previous video as well, if you want to look to partial. So then going over the next example. Now, I want to go over the different examples as well. I will not go over the same EU example. I want to go over Canadian dollar CHF, and afterwards I want to go over NASDAQ. So going over Canadian dollar CHF, we talked about the monthly as well, sitting right there, which can continue lower, of course. We know the context, we know the narrative by now. Then right here, we are continuing lower off of that. So at this moment in time, we can go into the 1 hour to look for our potential entry. Let's look at our risk management. Of course, the target was the weekly context, which is the intermediate term low. Sorry, it's actually this low on the 1 hour time frame right there. Perfect. So we had our first ST, and then we have our re sitting right there. Let's say we managed to get involved on the flood, the first line of defense, which is sitting right there. And we entered off of that covering what? Covering the lot, sitting right there, targeting a nice 1 to 2 again. Nice 1 to 2 sitting right there. When would we go break even? Right here. This is also where it gets quite interesting, because we need to, of course, also monitor the timeframes constantly. We need to be able to monitor those exact timeframes consistently. If we're not able to do that, then of course it will be quite difficult to know when we can go break even. What I mean by that is, let's say at this 1 hour entry that we had, there's a 4 hour value gap hovering like this, and before we hit the entry, before we hit the take profit, we expect a retracement into that to continue lower. We need to be aware of that. It's the constant hovering, it's the constant going between the time frames, seeing what is this doing, what is that doing. And that is the first step to achieving mastery in fair value gaps, is understanding time frames. Understanding time frames leads to overall mastery in the market, because you're constantly making a habit of that you are monitoring every time frame. You're aware what is happening above me, what is happening below me. More so, of course, the most important part is what is happening above me, on the time frames above us. That is very important. So right here, let's see. On the 4 hour time frame, do we have anything right there? We have a 4 hour value gap right there. Now, when does that 4 hour value gap get created? At this candle close. So that is at 9 a.m. sitting right there. At that 9 a.m. candle, would we now go break even right there? I would argue again, yes, we would be break even, Because if we demand, again, that high probability price action, would you now expect on the next candle a super aggressive move? So let me show you which candle I mean. Would you now expect here, based on candle signs as well, this 5 a.m. candle right there, that 5 a.m. candle is not really set up to trade into the 4-hour VWAP gap to then continue lower, right? No, it's set up to already continue lower. So here, would you go break even? I would argue again, yes, you would go break even right there. And that is, again, where we can now add on to confluences as well. Because here we have candle signs agreeing to the ID that we already want to continue lower. We don't necessarily want to trade into that 4-hour VWAP gap sitting right there. And we continue lower. So on the 1 hour, what did we also see? On the 1 hour, we are clearly seeing a beautiful overall ID of fair value. We talked about fair value as having sell side right there, buy side right there. So this area right now is overall fair value. This area is fair value. In other words, price does not have a reason to return there because we understand price is either offering fair value, so rebalancing something, or it's taking that liquidity. So right there, it is offering fair value. So we also understand that we should not ideally come back into that mitigation block right there again, because we've already offered fair value. So price is now seeking liquidity to continue lower towards that low sitting right there. That is again based on the theories that we talked about in the PD race and the analyst phase. That is quite important to understand. So that is another confluence on why we should not come back on the 1 hour, even though we have this 1 hour VWAP gap sitting right there. We would not expect a retracement overall. And again, once we create that new 1 hour VWAP gap lower there as well, that is a great sign right there to now go break even as well. So after that, of course, if you were to target lower, you definitely want to go break even once we have the context low taken. All right, let's dive into this example then a little bit higher right there into the 1 minute and into the 5 minute. So in the 5 minute and in the 1 minute, we can of course see it's a little bit different right here. And we follow along with price action. And on the 1 minute, the first thing we can see is that we had this ST right there, which we talked about. Then we have this re. Now, depending on where your entry would be here, if your entry is right there on the float, which is a little bit lower, or if it's on the overlapping defense, which is a more accurate entry, then going break even there is quite simple. It's again based on that candle signs, where right there, after this wick that we see right there, that wick, is there a reason for price to now return back to our entry level right there? No, not really. There's no real good reason. Now, do we need to go break even right there? If we didn't trust the setup, and I would say if we overall deem that to be a little bit lower probability, then I would say, all right, yes, let's go break even. If we think, all right, I definitely think the draw liquidity overall can be hit lower as well, and we're definitely delivering towards that context, let's wait a little bit. Let's wait then for this fair value gap sitting right there to be created. That fair value gap being created, again, is now a reason to go break even right there. Even though we have that lot is hovering in the entry, in the drawdown area, that lot, is it extremely likely to then trade into that exact point right there to then continue lower? No, because that would be overall low probability price action. Do we want to be involved in low probability price action? No, I would rather take a break even in low probability price action than stress myself out consistently and take losses overall because I'm hoping that price still wants to play out somehow. It's not what we want to do. So right there, this would be a break even, where at this moment in time, it is a little bit more difficult because here we're still close, right? We're still a little bit closer towards our overall entry. Here you can do, again, one of two things. Either right there, you wait for a new fair value gap being created sitting right there. Once we do that right there, that is where you also would now want to go break even. Is it very important, or is it very likely that price will now come back all the way towards our entry level right there? And the reason I say no, let me clarify that as well, is because we have we have quite a lot defenses withholding price from coming into that entry. And in the overlapping defense, of course, we have even more defenses. In the first line of defense, we have what kind of defenses? We have first this fair value gap, then we have this fair value gap right there, then we also have this order block right there. So it would need to disrespect all those to then come into the entry to then continue lower. If it's disrespecting all those, then again, my point is that means we are having low probability conditions, which means I do not want to get involved in the first place. So that hopefully makes sense, and that is quite important to understand. It's that requiring that expecting that high probability conditions constantly. That's what we want to see overall. And in your trading, you might have quite a few break-evens before you get that winner. Eventually, we'll move on to only picking those winners as well. That's something we'll get to. So in the last example right here, well, it's not the last example, it's almost the last example. Where right here, if we were to follow through on price, we also need to take into account, of course, now 5-minute fair value gaps. Where right there, we have this 5-minute fair value gap, for example. So at this moment in time, if we had a 1-minute entry right there, and just a philosophy right there that we had this 1-minute entry and something like this happened. We had this 1-minute entry and we covered that high right there because we did want to cover that 5-minute fair value gap. Then here, once we have this entry sitting right there and we have this 1-minute order flag going lower, sitting right there. Would you now go break even? Well, based on the 1 minute, we could argue, yeah, you could go break even. Based on the 5-minute, would you go break even? No, because now we have this 5-minute fair value gap above us right there as well. So we need to take that into account because the higher time frame right there, the time frame above us, is the one that rules, is the stronger time frame. So here we would need to wait for that first to then continue lower off of that. So here it again becomes a little bit more difficult to go break even. Why is that? Because right now we have again sabotaged ourselves where we have that sort of quote unquote bad entry, that drawdown entry where it's quite a lot of drawdown. So right now we have this fair value gap to work with. Yes, we also have this order block overall. Yes, but the entry is in the sort of the middle of the order block. So could we return back to that? That again then depends on where is your overall target right there. If it's a 1 to 2 sitting right there, then at this moment in time, I would not be break even. Of course, depends on the draw liquidity, which is overall these lows right there on the weekly context. And here, the more drawdown you're going to experience and the longer you are going to be in a trade, the more difficult you could argue the risk management is also going to be. Because right now we are also creating a 15-minute fair value gap above that price action right there, which we also now need to take into account all of a sudden. So the job all of a sudden became a whole lot more difficult right there. We do have this 15-minute fair value gap lower there as well. We have this 1 hour fair value gap that is also being created right there. There's a lot going on right now. All right, I basically messed myself up somehow. So what would we do in this situation? Because we still want to, of course, manage that risk, as in we still want to go break even somewhere. Well, right now, let's see what the 1 hour is doing. The 1 hour is having that 4 a.m. candle right there, which closes at 5 a.m. Let's see what the 15-minute is doing. We create that next 1 hour fair value gap sitting right there on 5 a.m. And on the 15-minute, that is the next candle right there. So currently, is there a reason to go break even? No, because all of a sudden, because we experienced a lot of drawdown and because we basically had a quote unquote bad entry again, where we just experienced more drawdown than expected, then all of a sudden, our 5-minute entry, our 1-minute entry now turns into a 1 hour trade right here. Because all of a sudden we need to take into 1 hour risk management. That is why what we talked about in targets. If you have a 1-minute trade, then it's a 1-minute target. So that is because we want to avoid a situation like this, where we're all of a sudden stuck with a trade ID that we sort of need to manage on every single time frame right now. That's going to be quite difficult. because it takes a lot of energy from you again. And especially if you're holding overnight, etc., definitely not something we are looking to do. So right here, what do we actually do? Well, the 1 hour Vervage gap is the one we need to take into account right there. So very simply said, what we now do is if we can get a retracement into that Vervage gap, perfect. All we want to see is a lower Vervage gap being created right there. Once we get this, same story, we're just simply closer to the drawn liquidity than to make a retracement into the entry to then continue lower. So at this moment in time, we would be break even once we create that expansion phase of the Vervage gap lower there as well. That is how we would go about it. But the moral of that story again is that you need to take into account every time frame. The longer you wait with an entry and the more drawdown you might experience, that means that all of a sudden your 1 minute trade could turn into a 1 hour trade because it's sort of pulled out of proportion where you now have to take into account 1 hour Vervage gaps, etc., which of course is ideally not something we want to have. So that is how you would go about that. Hopefully that makes sense as well. Then the last example that we have is NASDAQ right here, which will also be the end of the risk management before we get into time, which is the next video. Right here, we had this Vervage gap sitting right there. After that Vervage gap, as we sting into, we had this 5 minute entry pattern. And the 5 minute entry pattern was this ST sitting right there. A very nice ST to be honest, right there. And then after that, we had either the first line of defense or the overlapping defense right there as our overall entry. And we'll go over the different scenarios. After that, we can look to cover a lot. Here I would cover the bodies. Why is that? Well, I think this wick is quite long to get some extra aura, squeeze some extra aura out of it. Then we can definitely look to cover the bodies. Target a 1 to 2 sitting right there. Now, let's take this a few steps back, because what did I actually do right here? Before we dive into the risk management, let's go over the full story, the full context, before we see what happened right here. Because this is also where we are now looking to incorporate time. So, the two lines you are seeing on my screen, is this monthly, what is the order block that we're having right there? Then we have this Vervage gap overlapping as well. Perfect. That is where we can continue higher off of. To create context, to create this context, target this swing high that is sitting right there. Now, do we have monthly context right now? The monthly Vervage gap is still in the making, so we do not have any discount array right here. Perfect. So we go into a time frame below it. On the weekly, what do we see? On the weekly, we now see this weekly Vervage gap that we can continue higher off of to target that monthly high. Perfect. So right now, on the 4 hour right there, if I go into the 4 hour, we already had a 4 hour ST, which could have been an entry in itself, the 4 hour ST. Now, I waited a little bit longer right there. And that is where time now comes in. We had NFP on that Friday. That is why time allowed us to use this exact Vervage gap sitting right there. So with time, the confusion of using this Vervage gap, that Vervage gap, this Vervage gap goes away, because time tells us which PD arrays we want to use. That is very important. That is what we're going to go over in the next 2 videos. Then right there, you would now go into the 5 minute, which is after NFP release. NFP is the cause of that sting into the 4 hour Vervage gap, shows us the ST, shows us the re. In other words, the entry pattern shows us the confirmation, shows us the intention that price does want to move higher. Which on the 4 hour, what target did we have? Right there, with the overall drawn liquidity being the weekly context as well, because we're still in a weekly context, and the overall drawn liquidity being the monthly context right there. So we have 4 targets to work with. First target, the next drawn liquidity, and the last drawn liquidity sitting right there at the top. So here on the 5 minute, what can we do? On the 5 minute, we have the entry pattern, we have the ST, like we talked about, we had the re sitting right there. We cover the low right there. We target a 1 to 2, perfect. After that 1 to 2, we want to do what? Or sorry, after that context has been reached, we want to do what? We want to be break even right there. even before that context has been reached, I would argue that we want to be break even. Let's define this and let's go over this price action a little bit more right here. So the first thing we see here is that we have this entry, and the entry is accurate enough to now go break even. Why is that? Because again, it's here measuring. We're very close to the draw liquidity, that first target, the context high right there. That is already where we would demand ourselves to be break even. Whatever happens, we would want to be break even right there. Which also means that, all right, well, could we already go break even right here? Yes, definitely, because we have this huge expansion phase of the Verweij gap, a lot of bullish intention. We have this order block sitting right there. Then could we expect a retracement all the way into that to then continue higher? We could. Is that high probability to happen? No. So right there, if we don't want to see low probability conditions and we don't want to be involved in low probability conditions, we would want to go break even right there. So that is where we would want to go break even. After the context taken, of course, we definitely would want to be break even. Now right here, let's say we were still in the trade. At this moment in time, we are still in the trade and the target is higher. So it's way higher right there. All right, would we now want to go break even? Well, here, the 5-minute entry right now is not having a 5-minute target, meaning our 5-minute entry is not actually a 5-minute entry anymore, because now we need to take into account 15-minute Verweij gaps, which right there we have Verweij gap. Now we need to take into account 1 hour Verweij gaps, which we have a 1 hour Verweij gap sitting right there exactly at our entry right there. So what have we just done? The 5-minute entry we took just turned into a 1 hour trade overall. So here you would experience a lot of psychological emotions, as in you would experience a lot of psychological errors as well, because here you see price going higher, also coming back to our exact entry. We can't go break even because we have the 1 hour. At this moment in time, it's again accepting that your trade doesn't have the greatest entry, and currently it's because of your target as well, because you didn't have a 5-minute target. But overall, now your 5-minute trade turned into a 1 hour trade again. So to prevent this from happening is, again, if you experience a drawdown, that can happen, of course. It happens to all of us. But by not having that 5-minute target, you're basically sabotaging yourself again. So here, having that 5-minute target, that 1 to 2, then partialing, going break even, whatever it is, that would allow you to now go break even a little bit easier. So that is very important as well to understand. So right here, this is an example that we are going to dive into deeper once we get into time, which is going to be the next 2 videos right there. So understanding risk management, which is, again, mainly going break even. Trailing our stop loss is a different story, which we'll get into as well. But that is not really something I do, because as well, I want to have those 5-minute entries, 5-minute targets as an example. 1 hour entries, 1 hour targets, of course, where it isn't really required for me to have a trading stop loss or whatsoever. Break even for me is enough. Usually for me, it's a break even or it's just a take profit. No in between right there. So that is something we'll get into eventually, but right now we're just focusing on that break even and on the basics of risk management, which we also mentioned. It can be a little bit subjective. You'll get used to it. I truly believe that, and you'll understand it fully. I also truly believe that over time you will get used to this as well. With this logic, I hope it makes a lot of sense as well. If not, then please do let me know, of course, and we can go over it again. And we will go over it again, of course, because you'll see this return a lot of the times, because risk management is, again, one of the foundation levels. So it's at the foundation of trading. It allows us to be traders. That is very important to understand as well. All right, perfect. Thank you.